In our second theme, we talked about don't fear the yield curve and be flexible with duration. Essentially, what that means is we talked about the fact that the yield curve was flattening or even inverting, where the long rates were lower than the short rates. So the age-old adage in the market is whenever the yield curve inverts, we get a recession. Well, what this chart shows is that theme has accurately predicted 10 of the last 6 recessions. Exactly, 10 of the last 6. In other words, it doesn't always work. Now, what's interesting about this year, we saw a technical inversion on one of the measurements, but in reality, we didn't actually invert the yield curve. So the Federal Reserve came out in October. They said we're going to be aggressive. They said we're going to drive interest rates higher. The market was affected by that. We came close to a yield curve inversion, and that drove a lot of concern in the market. It drove equities down. It drove problems in the fixed income markets and in the high yield markets. Our message again here today is the Fed has already talked back that aggressiveness. The economy is still continuing to do well. There's trade talks with China right now. There's a lot going on in the marketplace that, again, speaks to continued growth. So yield curve is relatively flat. It is not inverted. We do not think that's the sign of the next and upcoming recession. Now, what is important to note is that we still think we're in the middle of the breaking down of the 30-year bull market. This next chart shows we are above trend for that 30-year downslide in interest rates. So while interest rates have pulled back from their high recently, they're still above the long-term trend, and we think that this is the beginning of a consistent pattern of interest rates going up. So what do we do with our fixed income portfolios? Well, first of all, we have to be flexible with our duration. Right now, we want to stay short. We've owned some floating rates, which means as rates go up and down, these bonds follow those rates up and down. As interest rates start to climb, we will start to buy longer and longer bonds, try to get those higher returns as risk slows down because interest rates are rising. High yield, we have some concerns. Last year, we said we were very concerned about the high yield market, and we're pulling out our high yield out of portfolios. As we'll see on this chart, the higher the chart, the cheaper high yield is. The lower on the chart, the more expensive it is. Essentially, this chart shows the spread between a treasury and a high yield. The spread is the difference in the interest rate you get from a high yield bond versus a treasury. When the spreads are low, that means we're not getting paid a lot of extra money for a lot of risk. When the spreads are high, we're getting a lot of money for that risk. For example, in 2008, there was over an 18% spread, which means if a treasury is 2%, you were getting 20. That's a lot of pay for a risk. Fast forward to 2018, and we were almost at 2%. In our view, that's just not enough return premium for the risk that goes with a junk bond or a high yield bond. Now, as you'll see, at the end of the year, the spread went up, which means the price of the bonds went down. There was risk there. They started to get beat up a little bit. They're starting to come back into a range where they're getting cheaper, but they're not cheap yet. And so we're still at the median. We really don't like to get interested in these bonds until they're at 6-7% spreads, and we're still well below that. So damage still done. Emerging market bonds do look attractive, though. They do look inexpensive. The next chart shows the spread on the high yield markets, the emerging markets. These look reasonable. We're starting to put money here in small doses.